Okay, so before we get started with finishing up our chapter 1 lecture, I wanted to point out that I did put, so I know I'd had requests for putting the book up so that it was easier to access, which we could always do in Blackboard. Like we could put a link in Blackboard where you just click and you can go right to your Connect section and all that. We can't do that now, apparently. At least I haven't found a way, and nobody's been able to instruct me. Yeah.
I know one of my other teachers has a link in theirs if you want me to.
Oh, really?
See who it was. If
Yeah.
You want me to let you
Tell
know.
me, because I haven't been able to get an answer on how to do that. But in the meantime, so I put up. These are some of the items that you might be more inclined to reference frequently. These are from the appendix. You noticed as well that I sent you out that standard deduction list, the chart showing what all the standard deductions are. Chapter 1 doesn't do a very good job of, they introduce that in chapter 2, but then they give you a homework problem in chapter 1 that concerns the standard deduction. So they can, I don't know why they do that. But just some links there. I wouldn't call them quick links because they're still going to take a couple clicks to get there, but it's faster than logging into Connect and then going to the book and then scrolling down. And we used some of these on Tuesday as well. So this one, that's that table that determines, when we look up the income, taxable income range and filing status to triangulate to get to the tax liability. That's that table. The tax forms, so these are just examples of tax forms that you can access to take a look at. This, I'm not sure what's in there. I think there was some links to the download of the software and then some other stuff as well. It's probably a duplication of some of this. And then this Appendix F, it says 2021, it's 2022. I need to change that. They have 2021 in there, but it is actually 2022. So this is those brackets, right, that we looked at, as well as some additional tax rates and stuff that you'll become familiar with as the semester goes on. So I put those up there on Canvas. It starts to get a little bit messy with all these different pages. It's the nice. I'm not lamenting the fact that we don't have Blackboard anymore because Blackboard was very clunky. However, it's nice to be able to put things in folders. We don't have folders here. Everything's a separate page. And then I also put in links to the chapters. So you can click on it and start looking at the textbook. Okay, I couldn't put the whole textbook up in one chunk though. I can only do it in individual chapters. But at least it's something. Alright. So any questions about that stuff? Alright. Let's let's go back a little bit here to the calculation of income tax. I know we went over this a bit, So you'll see that this is listed like as an assignment in the grade book. There's no points associated with it though. The only way I could post it was as an assignment, or reading assignment. Alright. So a couple of your problems and the homework will, and a couple things I want to point out that already students who are started working on chapter 1 homework have noticed, and not just in this class but also the online students as well. You've got to be careful of the wording. You've got some homework problems that give you total income, and then you've got some homework problems that give you taxable income. So total income would be the amount before any deductions. Taxable income would already include any deductions. So if you're doing a homework problem, so we've got our total. Say it's 100,000. And then we've got deductions. And what they're talking about here is the standard deduction. I sent you out that chart showing the different standard deduction depending upon filing status. They will give you the filing status. In your problems, if it says married, you can assume it's married filing jointly. Okay, you'll see that there are 2 filing statuses that have the word married in them, married filing separately and married filing jointly. It always means married filing jointly in your problems, okay? So the deduction is going to be based on that filing status. So let's just say married filing jointly, I think it was what, 25, 700? 900. So our taxable income is, what is this, 74,100? This is the number that you would use to apply to the table that would determine what the tax liability is. Okay? If they're giving you this, like I think there's a problem in there and it's similar to this. G and Min are married. They're filing a joint tax return. Married filing jointly. They have taxable income. Now here, they've given you taxable income. Their taxable income is $45,059. So they've already subtracted the deduction. So you can use that number to calculate what the tax liability is. But you do have at least one problem I know where they have a married couple and they've given you the income of both of those married couple, of both of those individuals. And your job is to add it together and then also determine what the deduction is to then arrive at the taxable income. So if we had a married couple, X and Y, we'll just say, and X made 43,000 and Y made 18,000, we would need, first thing we would need to do is add those two together, okay, to get our total income. 61,000, so here's our total. But you can't use that number to determine tax liability. You got another step that you have to take. You got to subtract this deduction. They're married, so then we would subtract the 25,900 and 100. What is this? 36. That's the taxable. So total, taxable. Unfortunately, they both start with T. But keep that in mind. So if you got a problem and you know that income number is right, but you're not getting the right tax liability, make sure that you have subtracted that deduction. Does that make sense? Okay. I know some of you probably haven't started on the homework yet, but you're getting the benefit of questions that I've already gotten from students who have started the homework. There. Okay. So So just make sure, just a heads up on that. Let's we'll look at Bill and Andrea, and we did a lot of this, but I just kind of want to review, just to get your brains working again. Get my brain working again. So here we've got Bill and Andrea Chappelle, a married couple. They have taxable income, okay, taxable income, so it's after deductions, of $48,305. They want you to determine their tax liability using both the tax table and also do the calculation to see what the difference is. We did some of these on Tuesday. We can go ahead and go through this one more time just to give you a reminder of how it works. All right, so $48,305. From the table, their tax liability is $53.88. Let's pull up the table and take a look at it. So $48,305. They're married, filing jointly. Oops. Scroll down. $48,305 is between $48,300 and $48,350. They're married, filing jointly, so we go over to the second column, and the amount is $53.88. Brilliant. You see that? Oops, I can't write it. Okay, so that's the but then when we now they want us to do the calculation on that taxable income. So $53.88 for the first part. Now we need to look at Appendix F. So $48,305. And we've got to find the right chart here, and it's the second one. Right? Married, filing jointly. Got to make sure we're in the right place. So $48,305. Bless you. $48,305 falls between $20,550 and $83,550. So we know it's going to be $2,055. Put that down. It's going to be at least that, but then we're going to add some more to it. Plus 12% of the excess over $2,550. All right, so we're going to subtract $2,550. 5, 2, 5, 7, 27,755. I have that right? That's the amount then that we're going to multiply by 12%, which is, I can't do that one in my head. Good if you give me about 5 minutes.
3,331.66. So 331.
We'll go ahead and get to the, so 33, 30, 60?
Yes.
All right, now we're gonna add those two together. 53.85.60 is the exact amount, which I think we were at 53.88 with the table. $48,305, yeah, 53.88 is how much it was with the table. So we're gonna use the one that gives us the greatest advantage. We'll use the 53.85.60. It would round up to 53.86. So only $2, but hey, $2 is $2. So we're using an exact number. So chances are, I think it probably was whatever is right in the middle of that range, so probably 40, like this one, 48,025, would probably be exactly with 5352. That's my guess. It might differ a penny here and there. But so if you're at the greater advantage, let's see, 48. Maybe not, maybe it's exactly 48,300. But you're gonna use whatever is the greatest advantage. Questions? No? Alright. So if you, why would we use these two different methods for calculating a tax? Why don't we just use the table? It's a lot easier. Well, it is a lot easier. As you can see, there may be an advantage to doing the precise calculation. So that may be one reason. But the tables only go so far. They only go up to taxable income of $100,000. So if you've got a taxpayer that has taxable income over $100,000, you can't use those tables. You've got to do the calculation. You've got to use the schedules. Now, the great thing is the software does that for you, but you've got in your homework, the software doesn't. When you're using the software, the Tax Act software, it will do the calculations for you. But when you're doing the tax return problems and the homework, obviously you have to do those calculations yourself. In addition to making sure that you're distinguishing between total income and taxable income, also in the homework problems, make sure that you're following the instructions that they give on whether or not to use the tables or the schedule. Because there are some problems where you could use the table, but they want you to use the schedule. Okay, so be careful just of your reading all of that and the wording, that you're following those directions. So there are a couple of clues there that if you're not getting the right answer, could be that you're using total income instead of taxable income. Could also be that you're using the tax tables and you're supposed to use the tax schedule, or vice versa. Okay? Questions? Yeah.
So what are some of the tools we should be looking out for? Like in some questions, it gives you the two table, the schedule, and what are some of the rule of thumb that will result you to table?
So usually what you're gonna use whichever one gets the best result. If they don't tell you which one to use.
Yeah, calculation.
Yeah. And sometimes it's just trial and error too. You know, you use one, you're like, oh crud. Usually most of the problems are pretty clear about how they want you to do it. But it's very easy to miss those those instructions. Okay? Believe me, I still miss them, so on occasion. So it's not just you. Alright. So let's talk a little bit about tax payments as well. Remember on the form, so recall on the form, we have a section for payments, but within that section, there are some credits listed as well. And remember I said these credits act as though they were prepayments. So maybe you didn't make the payment, but if you are entitled to, for example, this earned income credit, then it's as though you made a prepayment, and you're gonna get a refund back of that amount. There are a couple of special types of credits: additional child tax credit, earned income credit, American Opportunity Credit. These three credits are what we call refundable credits. Now again, don't get too hung up on the terminology. I'm giving you just kind of a little preview of credits. But we've got two different types of credits. We have refundable credits and we have non-refundable credits. The difference between the two, in addition to where they're located on the tax return, because the non-refundable credits are listed up here. So this Schedule 3 line is a non-refundable child tax credit, credit for other dependents. Now you'll see child tax credit is a couple of places. Child tax credit, and then we have additional child tax credit. That means that the child tax credit is partially refundable and partially not refundable. Like I said, I'm just giving you a preview. Don't start hyperventilating yet. I can see the fear in your eyes. But I just want to explain why they're in different places. So the refundable credits, which are the ones that are down here, along with the payments, act as though they were full payments, just as if you paid the cash. So if you have a $3,000 earned income credit, it's as though you paid $3,000. And if you're entitled to a refund of that, you get all that $3,000 back, even though you maybe didn't actually make any payments. Refundable means it can bring your tax liability below zero. So if you owed nothing, but you have one of these refundable credits, it means you get that money back, even though you owed nothing. Non-refundable credits cannot bring tax liability below zero. They can bring it to zero, but they cannot bring it below zero. So if it's a non-refund, say you have tax of $2,000, you have a non-refundable credit of $3,000, you only get to use $2,000 of that credit because it can't bring you down then below zero. But if you also have a refundable credit, then whatever that refundable credit is, you are actually going to get back. Okay, again, don't dwell on this too much. I just wanted to explain to you why they're in two different places. Why you see credits up here and you see credits down here. The credits that are down here are as though it was an actual payment. You paid as though you paid the cash and you're getting that cash back. Or if you still owed money, it goes toward whatever your liability is. So there are lots of different ways that tax payments can be made. Most common, and the way that the federal government funds most of its operations is through tax withholding. So when you have a job, they withhold the taxes at the source based upon the information that you provided to the employer. It will be calculated, and we're going to do all of that. We did that in payroll accounting, but we're going to do it again. Those amounts that act as prepayments will be listed here. So they help to offset whatever it is that you owed, right? So another way is through some Form 1099s, and if you recall from payroll accounting, Form 1099s report income that aren't wages. So different types of income. Could be self-employment income, could be interest income, could be dividend income, but there's been withholding. There's been some amount that's been withheld at the source. Not nearly as common as withholding on Forms W-2. This is the big one right here, and the one that you're going to be working with for the most part in this class is the withholding that happens here. So again, these are just prepayments, amounts that are paid in advance against, and then you get credit against the tax that you owe. Then we've got these other refundable, well, let me go back here. So estimated tax payments, you see here, and we do cover that briefly in payroll accounting, but not to a too great of an extent. Estimated payments are made by individuals who have taxable income, but they don't have it withheld at the source. Now, if you're an employee, you really don't have a choice in it. It has to be withheld from your paycheck. But a lot of people get income where they're not employees. The same types of income, self-employment income is probably the most common, where individuals are self-employed and they have to pay Social Security tax, Medicare tax, and income tax, if you recall that, again, from payroll accounting. But they don't have it withheld from any source. They have to actually directly make that payment themselves. And they have to do it 4 times a year through these estimated payments. So, but again, they act as prepayments, okay? if you had a refund, it says here, so estimated tax payments, those would have been for the current tax year, and amount applied from 2021 tax return. If the year before you had a refund, but you said to the IRS, no, I know I'm gonna owe you money next year, so you just keep that money, okay? Apply it toward next year. I'm getting $1,000 refund, but I know I'm gonna owe even more tax in 2022. IRS, keep the money, you're welcome, but you're gonna apply it toward my next year's taxes. Again, that's a prepayment of taxes, and it would be included then on this line 26. Then we've got these refundable credits, those credits that are as though you made a payment, and you'll get money back even if you have zero tax liability. All of that is added up for our total payments and credits. And then that is applied to whatever our tax liability is. So if our tax liability is $10,000, so we have, oh, I took my marker back there. So tax liability, all right, so we have tax liability that we calculated on line 16 as $10,000. And then we don't have anything on line 17, so line 18 is also $10,000. Say we have a child tax credit, CTC, of $2,000. All right, so now we're down to $8,000 of our tax liability. We have none of these other ones, so our total tax, this line 24, is $8,000. And then we had some money, this is how much we owe. Now we get to calculate how much we've already paid in. So we've got payments that we made, line 25, from our W-2 withholding. Let's say we had $7,500 in withholding. But then we also have an earned income credit. Say it's line 27, sorry. I'm looking forward to the tech upgrade in this class. EIC earned income credit of $3,000. Okay, wait, 8,000 minus 7,500 minus 3,000, now we're getting into a refund territory. Even though before this, we would have still owed $500 because of that earned income credit, now the IRS owes us money, okay? So that gets us to our refund of, let's see, 2,500. So we get a check for $2,500. Now maybe next year, we already know, gosh, we're gonna make a lot of money this year. Don't give us that $2,500 back, just apply it to the next year. Then what's gonna happen is that $2,500 is gonna get added into here next year as a prepayment. Okay? Questions? Again, you don't have to get into the weeds. I know I'm getting into the weeds. You don't have to get into the weeds yet. I just wanted to explain to you all of these lines and what all of that means, okay? And where it all goes on the tax form. And believe me, I do not expect that you're gonna be able to look at a tax form right now and know exactly, oh yeah, that lines 15, that's where taxable income goes. I don't even know that stuff. I have to refer to the forms frequently. It's too much to remember without reference, okay? So, that's this tax payments. I think what is this, Ed Davidson? Yeah, this is your Tax Act assignment for this week, or for next week. We'll look through this after I finish up talking about the tax authority. This stuff, you really don't have to know about this stuff anymore because it doesn't apply anymore. But we'll read through this. We'll do this today. We'll read through that. All right. So that gives you overview of the tax, the Form 1040, where everything goes, generally speaking, how we calculate that tax liability based on the taxable income. We talked about the deductions, and right now it's the standard deduction. When we get further into chapter 5, I think it is, you're gonna find out that there are other types of deductions, itemized deductions that you could take instead of the standard deduction. But until we get to that point, we're just using the standard deduction based on filing status. So we talked about how to, if we start with our total income, then we subtract those deductions to get to our taxable income. We used that taxable income, either applied it to the tax tables or calculated it using the tax schedule. Again, that's based on filing status and our taxable income to arrive at what our tax liability is. And then we also talked about tax payments and how there are certain credits that act as though they are payments, right? Questions up to this point?